Hey everybody, we are going to cover closing entries today. So, closing entries in Chapter 8 talks about the last two steps of the accounting cycle. So, it talks about getting those temporary accounts set up and zeroed out and prepare them for the next accounting cycle. And then so that is step number 7. And then step number 8 is doing our post closing trial balance. So making sure that everything is ready for that new accounting cycle. So the first part of chapter 8 is recording those closing entries. So we want to make sure that you know exactly what accounts to close. So we have two types of accounts. We have our permanent accounts. Those are my assets, my liabilities, and my owner's capital. Those accounts are going to have a balance from period to period to period. So we do not want to close our cash account from each period because that cash is going to grow, hopefully, right? We don't want to close our accounts receivable and accounts payable accounts because those are our customers and our vendors, because those balances are going to keep with those companies. And we don't want to close our capital because our capital is our investment. And so the money we bring into our business, we want to keep invested in our business, which means it has to grow. So that's the reason why we would not close any permanent accounts. Now, our temporary accounts, those are the ones that we need to keep track of period to period. So, for example, sales, and this is a great example. We keep track of sales for one period at a time. So, by period, in most of the examples that you guys are using is a month, but for most companies, it's for the year. So, we want to keep track of how much money in that sales account we are making per period. So, it starts with a zero balance at the beginning of the period, and at the end of the period we close it with a zero balance to get it ready for the next period. The reason why we do that is so that we know how much sales we made in each period. If we didn't do that, if we didn't close it at the end of each period, then 5 periods down the road or 5 years down the road, we're going to have to we wouldn't know how much we made in year 5. We would have to go back to year 1, and then we would have to look at year 2 and then subtract year 1. And then we'd have to go to year 3 and then subtract year 2 and year 1. So it becomes a huge mess. So for us to know how much money we made in each period is super important. That owner needs to know what months they're doing more money, what months they're making less money. And so that is why it's extremely important for us to close those temporary accounts. So our temporary accounts are our revenue, which is our sales, and our expenses, which is like advertising and miscellaneous and utilities. And then also we have our owner's drawing account. Now we close the owner's drawing account because we want to make sure that the owner, because the amount of money they're taking out is for that time period. So we want to make sure that we know how much money, right, we're making in sales compared to how much money they're taking out in drawing. Now, in those closing entries, right, we're taking all of those accounts, all of those temporary accounts that have been open for this period, and we are closing them. We're giving them a zero balance, so then that way they start fresh for the next period. So we know exactly on day 1 how much money we make and how much money we're spending. So there is an account that I I know you've seen and hasn't been talked about, and that account is this income summary account. It is classified as an owner's equity account. It will be like number 330 after drawing, and this account is temporary. We typically do not use this account but one time during the period, and that is literally at the closing, because it's going to do what it says. It's going to do what its name says. It's going to give us a summary of the income. Now, our income, when we looked at the worksheet, right? On our worksheet in the income statement, what are the two types of counts in that income statement? If you said revenue and expenses, you would be correct. Those are the two types of accounts that are in my income statement section of my worksheet. And that is what's going to summarize my income. I have my revenue and I have my expenses. So when you did the worksheet, when you took your revenue minus your expenses, what did you find? You should have found either a net income or a net loss. And that's what this account is going to do. It's going to take that information. I call this the dumping account. We're going to dump stuff in and then we're going to dump stuff out. It's going to be open for about 5 seconds. So I'm going to dump my revenue in. I'm going to notice on the credit side it says revenue. And I'm going to dump expenses in. Notice on the debit side it says expenses. What do I do to a debit and a credit? I subtract them. And that will give me either my net income or my net loss, right? So if it has a net income balance, it will have a credit balance. If it has a loss, then it will have a debit balance. So that is where this, like I said, this account is only open for about 5 seconds. We dump stuff in and then we dump stuff out. So here is our first example of our first of 4 closing entries. There's only 4. So our first closing entry, notice I'm in the general journal. If you look at the green where it says account and then an income statement, where is that from? Hopefully you recognize it as the worksheet. Okay, that's where we're going to be getting our information. So we have our general journal. This example, it's page 3. We have our closing entries. We label it because that tells whoever is looking that the entries after this are special, right? We're doing them once a period. So our first closing entry is on the last day of the month, whatever that month is. You see sales is going to be my debit. Now notice in the income statement, sale is a credit. So in order to make a credit to 0, in order to get rid of it, I have to do the opposite, which means I'm going to put it in as a debit. And then that debit is going to be put into income summary as a credit. So that is transaction number 1. That is my first transaction to close my revenue account. All right. My second transaction is closing all of my expense accounts. So notice in the income statement, all of my expenses are debits. Okay? What they also don't show is they give us in the income statement the total of the debits. So, in order to make all of my debits 0, I have to credit them. So notice you have your advertising expense all the way down to supplies expense, and they're all in here listed as credits. And then once they're totaled, that's the number we're going to put into our income summary. So this is the total of how much money we spent on our operating expenses for that period. So that is transaction number 2. So now we've closed our revenue and our expenses. So remember, I said in our worksheet, in that income statement section, right? When we took our revenue minus our expenses, it gave us our net income or net loss. Okay? It gave us our net income or net loss right here. See, this minus this equals our net income. That is the amount that should be in our income summary. So as we're going, we're posting, right? We're updating these individual accounts, and net and income summary should have a credit balance of $3,162 because we have a net income. So that $3,162 is going to be put into capital, because remember, capital is investment. And in a small business, every amount of profit that we make gets invested back into the business, which means that net income gets invested back into the business. And the account we use for investment is capital. Right? The account we use for investment is capital. So that investment, that net income, is going to be invested back into the business. All right. That is transaction number 3 of our closing entry. So now, income summary closed. We opened it to put in sales. We put in some expenses, and now we're taking what is left and we're putting it into capital, and now that account is closed. That's why I call it the dumping account, and it literally is open for 5 seconds. So that's transaction number 3. All right. Now we have our last transaction, our fourth transaction. Now we have to deal with the owner's drawing, right? The owner's drawing is them withdrawing money or whatever, whether it be supplies, whatever, from the business. So that's taking away from the investment. That's taking away from the investment. So that's why you see the first part of the transaction is capital as a debit, because normally capital is a credit. So, but we've got to take that money out because they took it out of the business. They took that investment out. So drawing is going to be my debit or my credit, and capital is going to be my debit. So then so this is our final transaction. Now, all of my temporary accounts have been closed. All that's left, and I'm going to show you the example, all that's left is our accounts that are still our assets, liabilities. All that's still open are those accounts that still have a balance. So if you look at the general ledger, notice cash still has a balance, petty cash. All of my assets still have a balance. My liabilities, my accounts payable still have a balance. My capital still has a balance. But notice my drawing. Now it has a 0 balance. My income summary has a 0 balance. So this is what it looks like once that income summary account's been posted. Here's my sales credit. Here's my expense debit, right? And then that 3,162 is what I closed into capital. And notice there's no balance there anymore. It's gone. So now sales is gone. And all my expenses now have a 0 balance. So that's what our general ledger is going to look like after we post those closing entries. So that is step number 7 in the accounting cycle. The last step is to make sure our debits equal our credits for those accounts, right? For those accounts that are still open. So we have to do our heading, right? We have our who, our what and our when. Notice our when is for that last day because we're just looking at those ending balances. And we write down only the accounts that are still open. Only the accounts that are still open and have a balance. So here's all of my assets. Here's my expenses or my liabilities, accounts payables, right? And then here is my only account, my only owner's equity account that is left open, which is my capital. So once we put in our numbers, so you'll put in your accounts, you'll put in their numbers, you'll single roll because that says the next number is going to be our total. And then we're going to add up our debits and get a number. We'll add up our credits and get a number. And these two numbers should equal. Our debits should equal our credits. If they do not, then we did something wrong. We did something wrong. We wrote a number down. We did some math wrong. We have to double check that. But if our numbers do equal, then we're good to double underline because that shows that those numbers have been double checked and they are right. That is chapter 8. So that is walking through those 4 closing entries, walking through how to generate our final statement, our final financial statement. This is, I always say it's all about just the format of these reports, right? Income statement, balance sheet, statement of owner's equity, post-closing trial balance. It's all just about the format. And then you just have to plug in the numbers in the right spot. So once that post-closing trial balance is correct, and we know that our numbers are good and we've double underlined, now we're ready for February 1st, right? Because this says January 31st. Now, all of those accounts, my assets are good, my liabilities are good, my owner's equities are good, my revenue and expenses are now ready for that next period. All right. Hopefully, if you have any questions, hopefully I answered all of them for you. And have a great day. And then here's the accounting cycle.